Eric, let's talk about the outlook for energy for the new year. Can oil match its performance in 2022?
I actually think we're going to have a better year next year than we did this year. Frankly, this year's been a little disappointing, which is funny because we're up about 45 odd percent, but we're suffering from recency bias, remembering where we were in the summertime. And we've had oil check back pretty meaningfully, I think primarily on account of recessionary fears, a disappointment with the impact of loss of Russian production from EU embargoes, and then China COVID zero. So, despite all of these very, very strong headwinds, it's been a tough year, so to speak, at least for oil. The energy stocks have done well. So I looked at 2023, we're starting at about $77, $78, and we've got China indicating that they're slowly opening. It'll be a gradual process, but nonetheless, that means an incremental 1.5 million barrels per day of demand. We have the SPR release finally coming to an end. That's 800,000 barrels per day. And then we've got this EU embargo on Russian crude, which we've got various agencies saying will impact their production by 800,000 to about 1.3 million barrels per day. And so much of those headwinds, both psychological and actual, that we've been battling throughout 2022 come to an end. And so we're very optimistic that next year is going to be another very good year for energy investors.
Let's just unpack some of those themes. We saw or I guess if you could just explain the correlation or I guess divergence that we've been seeing between energy stocks and oil prices. Do you expect more of the same for the new year?
What I think it indicates is that there's a realization that energy is the only game in town. And if you do not have oil stocks on your books, you have massively underperformed this year. And that trend is likely to continue. When we look at valuations, when we look at free cash flow, when we look at dividend yields, the energy stocks and energy sector really, really compare very well. They blow every other sector out of the water. And so with a strong macro backdrop, where for the average generalist, it's probably easier to buy energy stocks today at $78 than it was at $120, where you've got this realization again of performance lag and performance anxiety on the part of generalist fund managers, fearful of missing out on further gains. I think that's been supporting the energy stocks, even though we've had this modest check back and I think temporary check back in oil.
You and I have often talked about U.S. shale, and will we see the winding down of U.S. shale oil?
I think we're nearing a peak in the next couple of years. What we're seeing is well degradation. So shale wells are getting worse over the past couple of years. We're seeing that shale wells are getting gassier. And the most important thing is that energy investors are demanding to be compensated for the misery of the past decade, the worst bear market in the history of the energy sector. And so this philosophy, this necessity of not growing meaningfully and instead maximizing free cash flow and returning that back to shareholders in the form of variable dividends and buybacks, that is a new religion amongst shale companies. And that has a massive, massive impact on the outlook for shale growth. We look at this year, coming into 2022, many people thought that we'd be growing by 1 million barrels per day. The IEA is saying that next year on growth of 900,000 US shale. We think those numbers are massively too high. We think shale growth next year will be about 400,000 to 500,000 barrels per day, in the context of over 1.5 million barrels per day of demand growth next year.
And will we see more payouts next year? As you had just mentioned, a lot of the companies were rewarding shareholders, and they had pivoted, I guess, their priorities away from investments. More good news for shareholders?
Yes. So we've been a champion of share buybacks in Canada, where we believe that the most assured way of revaluing energy stocks back to more normalized valuation levels is for companies to use their free cash flow to buy back their shares. We're seeing that. Most importantly, this year, the big theme on 2022 has been deleveraging. Get your balance sheet to a point where you're comfortable. At that point, you reach the inflection point of being able to return money no longer to the bank, but to shareholders. And that's where we are in 2023. We have multiple companies announcing that, in the next couple of weeks, they'll be pivoting to 100% payout ratio. And so when we look at between $80 and $100, some companies able to, buy back 10% of their stock while paying an 8% dividend at 80. Conversely, at 100, that 10% buyback and paying out a 15, 16% dividend. So the outlook for returns, meaning dividends and share buybacks for energy investors next year, is awesome, because not only I think we'll have a cooperating oil price, but the majority of companies in Canada will have reached their leverage metrics, allowing them to return more and more and more free cash flow back to investors. So the patience that many of us have had to have this year will be getting paid for that next year.
Eric, you had mentioned that China reopenings just maybe one of the elements that'll affect demand. What is the expectation for demand in the new year?
Yeah, so we've seen their demand this year, and it's been one of those headwinds, which I don't think many people thought their COVID zero policies would persist this long, has blunted their demand by about 1.5 million barrels per day in 2022. And so with every day now, you seem to get more and more announcements of easings of those restrictions. We're seeing domestic airline travel just surge, like massive increases, admittedly off of the lows, but the trend is very, very powerful. And so I look next year and say, well, inherently, even under a global recession, I still think demand for oil is going to grow. Plus, you've got the Chinese normalization of 1.5 million barrels per day. Plus, you've got the end of the SPR release of 800,000 barrels per day. Plus, you've got the potential for finally Russian production to be impacted by EU embargoes. And so it's this tightening and tightening and tightening theme which will draw down inventories, continuing that trend throughout all of this year, putting very significant upwards pressure on the oil price. And so, yes, we've had a check back in oil. The more it falls, the more people are getting bearish. But I think it's this theme of price setting narrative. We're directed by fundamentals, and it might be the fundamentals have really not eroded that much in the past couple of months.
Do you see recession, the possibility of a recession, as a downside risk to demand?
I don't, because most people will say, well, a recession equals falling oil demand, and that's factually incorrect. Yes, we saw that during COVID, the recession of 2020. Yes, we saw that in 2009, the prior recession to that, as demand fell by 2%. But those were very, very grave conditions, which I don't think most mainstream economists are calling for. The two recessions prior to the great financial crisis of 2009 still saw demand for oil grow. And so this maniacal focus on, my God, if we go into recession next year, oil demand is to fall. One, that's it wrong. And two, the market's forgetting about all of those offsetting factors. At the end of the SPR release, the normalization of Chinese demand next year, EU embargoes, et cetera, that can more than offset any demand destruction that we get from a recession, with the backdrop of still massively curtailed production growth. Like, you shouldn't be bullish on oil because of what's happening in Ukraine and Russia, or SPRs and whatnot. It's simply because, for this basic tenet, the demand for oil will grow for the next 10 years, and supply growth globally is massively challenged and can't grow at the same pace. That's why I'm bullish on oil. And that's why I think energy investors should tune out the noise about all of this policy confusion and policy risk that we've had this year, and just focus on the fundamental setup for crude.
What is the expectation from OPEC when it comes to supply policies for 2023?
Yeah, I'm actually going to be meeting with them in country next month, which I'm really excited about. So hopefully we get some good tidbits so we can have a conversation after that point. I think OPEC is looking at a world where you've had governments in Western nations attack oil this year. Biden administration with the SPR release heading into a midterm election, EU and US with price caps that they're, I would say, probably concerned about potentially being employed on them one day. And at a time when OPEC spare capacity is negligible to nil, where you do have the likelihood that finally Russian production will be impacted, and their unwillingness to be in a world where, because of chronic underinvestment, they're the only source of supply that could offset that. So I think it's really precarious next year. We are critically short oil next year, even under a modest or to moderate recession. So I think OPEC's, gunning for $90 Brent or higher. They got a taste of what that is like after many, many years of misery, where they've been depleting their foreign exchange reserves to maintain social spending. And so I think next year you'll see, again, the exhaustion of OPEC spare capacity and the willingness and desire to protect a meaningfully higher oil price than where we trade right now.
Lastly, your prediction for WTI, where does it go? Where does it end up?
I was disappointed this year. I thought we would be ending $100, and we're clearly not having that happen. And so it's, giving price and time are two very different things. I would say with the opening up of China, which is going to be a several month or quarter process, but inevitably that's where we're going with, likely Russian production with the end of the SPR. And frankly, where we already are now in terms of inventory levels relative to demand, like demand's back to pre-COVID levels. We're consuming about 102 million barrels of it every single day. We're at multi-year low inventory levels. So personally, the fundamental price, I think, should be at $100 already. I think we'll get there at some point in 2023. And so with that backdrop, we think energy stocks are profoundly mispriced.